In today's video, I want to touch on two growth companies that have seen their stocks come down over 20 to 30% in the last couple of weeks and months. Now, these are high quality businesses, so these are still today not trading at a cheap valuation, not trading at a low PE. So keep that in mind. Now, as always, I'm not going to waste your time. So the two companies we're going to touch on in this video is Shopify and Duolingo. If that's interesting to you, hopefully you stick around. If not, hit that subscribe button and like button. We'd really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so company number one is Duolingo. This is one of the most underrated names in the market. It's one of those names that has, well, beaten the market quite comfortably. In the last 3 years, it's up 273%. And since it became a publicly traded company, it's up 141%. Year to date, this stock is up 2.8%, has a market cap of $14.9 billion. And like I said, not a cheap name at all. PE here, 175.2, trailing one. Forward PE sits at 123. So definitely not the cheapest name out there, but it's one that is growing extremely quickly, top and bottom lines. Free cash flow margin of 36.5%. If we look at the expected revenue growth 2 years out, 27.9%, EPS sits at 47.4%. So yeah, you're paying a premium here, but you're paying a premium for a company that is probably best in class and maybe one of the better names out there. One of them that is definitely not in the whole tariff situation. I'd also like to thank FinChat for supporting this video. Now, you know, I've been using FinChat for quite a long time. It's a stock research platform. You've seen it pop up in many of my videos. Now, as you know, if you're a new user, you can get 2 weeks of FinChat Pro for free. Or if you enjoy it that much, you can use always my link down in the description and in the pinned comment to get usually 15% off, but I do believe that in the next couple of days there's going to be a higher discount up to 25%. Yes, a bit like the tariffs. Yes, we're going up a bit like the tariffs, but this time it's actually helping you. Now on FinChat, of course, if we're looking at Duolingo specifically, we can look at what I like to look the best here on this platform is the segments and KPIs. And in this case, if we look at subscription bookings more specifically, and the growth rates of it, well, it gives you that as well. As you can see, it has been going up and down, up and down. But if you look at the exact number, we're still even in the lows here. March 2023, that was still growing 40.2% year over year. Then if you look at March 2024, 46.6% growth year over year. And last quarter, close to 50% year over year growth. So despite, even if we look here at the annual one, despite it, well, growing quite quickly. I mean, since 2019, this has grown at a compound annual growth rate of 58.83%. And yet, 2024, we were still growing 47.5%. So the momentum is definitely here still with Duolingo. We will look at a lot of other specific metrics for Duolingo as we go through this video. So if you want to use FinChat, you can use it for free. If you're new, for 2 weeks, FinChat Pro for free for 2 weeks. You can sign up using my link down in the description and in the pinned comment. You can also get, if you want to upgrade, 15% off usually or 25% in the next couple of days. Moving on to what the market is expecting this company to do, especially when it comes to free cash flow. Well, free cash flow for the next coming fiscal years is still going to grow between 25 to 34% year over year. So the growth rates here again are quite impressive. If we look at the margin profile of this business, gross profit margin has been stable and actually growing, went from 70.7% in 2019 to now 72.8%. If we look at free cash flow margin, that keeps on increasing on our 36.5%. That's up, well, quite a lot since, well, the 2.2% in 2021 or even the 8.9% in 2020. Looking at where they generate the majority of their revenue, well, there was a change in reporting. So previously we got UK revenue and rest of the world. Now that's combined into one. So rest of the world is the biggest chunk, not surprising. But then if we look at United States, that's still at $311.5 million. So very important market for them. We know where the revenue is generated from, but how? How is it generated? Well, we have subscription revenue, which is the largest segment right here, $607.5 million. Then we've got advertising that has grown also quite quickly. Duolingo English test is the next one at $45.6 million for the whole fiscal 24. And then in-app purchases sits at $38.7 million. Looking at the daily and the monthly active users since 2019, the daily one has grown at a compound annual growth rate of just over 50%. The monthly active users have grown at a compound annual growth rate of 33.7%. Looking at paid subscribers, that has also grown quite nicely. Compound annual growth rate here since 2019 sits at just over 60%. So of course, you would expect the more and more users they attract, the more and more daily or monthly active users they attract, well, the better the conversion is going to be to paid subscribers. And then of course, we see something like this, which we've seen before, the subscription bookings and the growth rates there. I mean, quite astonishing, and it makes sense. This again, I'm not saying you have to pay the super high premium right now, but there is a reason why. There is a reason why this stock is not getting hit as much as some others, and there is a reason why the market wants to give a high premium for this company. Moving on to company number 2, and that's Shopify. Shopify is trading right now at $85.55 before the market opens. Market cap of just under $110 billion. Here you can see the drawdown sits at 33.8% more recently. Well, we're actually closer to 40%, but well, the majority of the stocks did rebound last week. Here as well, if we look at the trailing PE, 54, forward PE sits at 56.5 times. So here again, not a cheap name. Free cash flow margin sits at 18% and improving. And here as well, growth for revenue is still above 20% for the next 2 years each and every year. Same for EPS. And currently the average analyst price target sits well much higher than the price we're at right now at $132.49. And here if we look at the expected growth for free cash flow in each and every fiscal year, well, you can see it's above 25%. So 26% for fiscal 25, close to 26% for fiscal 26, and then 27.7% year-over-year growth in fiscal 2027. For Shopify, to me, it's all about the free cash flow story. As you can see right here, free cash flow is improving year after year. Gross profit margin has been coming down a little bit, although in the last 2 years it has improved a tiny bit. But again, I'll repeat it, it's all about free cash flow margin. And of course, more recently, we've had that Toby Lütke letter to their employees, basically talking about the power of AI. And well, if you want us to hire a new engineer, someone new to add to the team, prove that AI cannot do the same job or cannot do a better job. And to me, this is a message to Wall Street as well, to investors as well, saying, look, we're going to be using AI heavily. You can expect us to have, well, margin expansions going forward. Because instead of hiring a new engineer that costs you probably $250,000, $300,000 a year, no, you're probably going to be using an AI companion, which isn't free, but probably costs you way less than $250,000 a year. And so I fully believe that we're going to see margins continue to go up. Now, how does Shopify generate revenue? Well, they generate revenue to two segments. One, subscription solutions, which is the orange one right here, which has grown at a compound annual growth rate of 31% since 2018. And then the merchant solutions, this is the one that is growing much faster, has grown at a compound annual growth rate of 48.5% since 2018. And last quarter, subscription revenue increased a little bit faster than a merchant one. If we look at where they generate the majority of their revenue, it's still the United States. Then you have Europe, Middle East, and Africa, then APAC and Canada. Now, I know what you're going to say. Oh, but it's a Canadian company, tariffs, does that not impact Shopify? Well, Shopify, I hope you know what they do. It's not directly impacting Shopify. It might indirectly impact a business like Shopify because, well, the people that are using Shopify services, they might or they are impacted by tariffs. And of course, if their business gets hit, then indirectly that can hit Shopify as well. Because remember, we've seen merchant and subscription solutions here. This is how they generate revenue. So if some of the businesses that do operate on top of the Shopify stack, if they are getting impacted, if their business is not growing as fast as previously expected, if they have to take some hits, then yes, indirectly, that might hurt a company like Shopify. But directly Shopify, I highly doubt there is such a big hit on them. Moving on here, looking at gross merchandise volume and gross payment volume, GMV and GPV, we can look at GPV growth here that has grown last year at 32.1%, and you can see that has increased for the second year in a row. We went from 23.7% year-over-year growth in 2022 to then 29.1% in 2023 to then 32.1% in 2024. And as for GMV, that has grown at a compound annual growth rate of 38.6% since 2018. Of course, we have that big increase because of the pandemic, but since then, well, it has continued to grow quite nicely. Now, as you know, me personally, I went all in with Amazon, but with Shopify, I always said the same thing again and again. Incredible management team, great business model. But at the time where I made the decision, I thought it was too expensive, didn't make that much sense to me. Amazon was also quite cheap, had AWS, had all the other things there as well. So I went with Amazon. But to be honest, a Shopify, right now, of course, it's cheaper than before. It's not the cheapest name out there, not at all. But it is a company that I can see continue to grow and beat the market quite comfortably for many years. Don't forget, when you invest in these types of companies, especially if it's more expensive than the other, it's important to know, well, it's important that you invest in the business, in the leadership behind it, especially the people behind it, because the people behind it, they will know how to navigate difficult situations. And this is worth paying a premium for. There are plenty of other companies that are trading at a cheaper valuation, but do you trust management enough to make sure that even through volatile times, even through all this tariff war, AI change, do you believe in them to, well, steer the business in the right direction? Yes or no? With Shopify, with the leadership that they have, I can say quite comfortably, yes. And so all in all, that's about it. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, do share your thoughts on both companies. Do you own them? If it's on the watch list, let me know down in the comment section below. Don't forget to check out FinChat for the usual 15%, or in the next couple of days, you can get 25% off. Links are in the description and in the pinned comment. Thank you very much, and I'll see you all in the next one. Bye-bye.